All right, ladies and gentlemen, we're back here with another edition, perhaps a special edition of the Emerald Financial Group podcast. Today I'm joined by Michael Cornips. Michael?
Good afternoon, Sam.
Good afternoon.
I was about to say good morning, but who knows?
Who knows? We could be at any time of the day, in any place in the world. And this edition is brought to you by Traders Circle and Emerald Financial. Traders Circle, one half of the business is a business for traders, by traders to support trading. And Emerald Financial Group is all about investment advice, research, analysis, and products. And look, guys, we really hope you enjoy this one. Mike's put a lot of work into his presentation and then a lot of knowledge into the content of the presentation. If you do enjoy it, please hit the like button. Let us know in the comment below. Put any questions in the comments below. And subscribe to our channel. We got content coming out fairly frequently.
Yeah. So Sam, I think there's a lot of things we could talk about the market, the little intricacies of the futures markets, the liquidity. I think today and the next few weeks or so, I think we're focusing on the macro.
Yep.
The macro big picture. Where we've come through the COVID period in 2020, where we all got an avalanche of money, job seeker and tax rebates and massive government deficits. And for those of us who believe in if there's a healthy amount of money, newly created money coming into the market, it does push up asset prices. And I think we spend a bit of time investigating the mechanism of that. But the outcome of the government actions 2 years ago, 3 years ago, is a lot of asset price inflation, and from the quantitative easing and from all that money that came into our bank accounts, we found a great reason to spend another $1,000 on that iPhone we don't need. So we were in denial through last year on the inflation coming. We all thought it was transitory, and the federal U.S. federal government, certainly the Federal Reserve, certainly thought the inflation was transitory. But as the numbers came in, inflation started to pick up, and Chair Powell unequivocally just started aggressively raising rates.
Yep. And
whenever the market got exuberant and ahead of itself, thinking that inflation will start coming down, he's quite aggressively told them, look, you're wrong, guys, pull your head in. So we've had a couple of false starts in the relief rally. And I think over the next few months, the story is, look, what is that terminal rate of interest rates we can go to? At this stage, I think it's 5.5 in the US.
Up to 5.5. It keeps getting lifted and pushed out.
Yeah,
it was 5.25 in June, and it's now 5.5 September.
It's like a good psychological trick. Just push them 0.25% at a time. I remember a while ago we thought 3.5 was quite a bit. The Australian Reserve, not the biggest fan. He was quite reluctant to push up interest rates. He went back from 0.5% increases back to 0.25%, and he seems to have changed his mind. Like he changed his mind telling borrowers to borrow money at point.
We won't lift rates until 2024. So,
and he was able to walk away from that. And us as licensed financial advisors, I think we might have gone to jail for that.
Oh, absolutely.
He didn't give us a statement of advice, and I don't think it was suitable for our personal needs.
I think he's not above criticism, and I think there's certain actions, or a fair few actions that he's taken that I think leave themselves open to criticism. And perhaps recently, when Governor Lowe met with investment banks just before the RBA rate decision,
Darren Joey,
and he says, well, we have to get out there and speak with the man on the street. Well, I think the man on the street who's perhaps most affected by these interest rate rises are your marginal borrowers, out in Craigieburn or Cranbourne or, the outer suburbs whose loan-to-value ratios are getting a bit stretched. as opposed to, you know, these financial money market guys who will be fulfilling their role regardless of the interest rate.
That's right. Yeah, you might say 30% of people don't have mortgages, so they don't care. They're enjoying the wealth transfer because they're savers. There's probably 30% of people who've got some sort of mortgage but are pretty comfortable. But that bottom 30% really notices a difference when it goes from 2%, probably up to 5-6%. They certainly know the difference. And then that inflation certainly feeds into more inflation. But look, just to keep things moving, I'll just go to our first slide. And this has come, the blue and orange lines come from the US Federal Reserve. From the US Federal Reserve, and it's their inflation expectations. So the top blue line is the consumer price index for all the US cities. The orange line beneath it is the expectations of inflation, the surveys they do. And then I've put a bottom line in. The bottom line is that grey line is what the bond market has been pricing inflation at since 2017, and pretty much, as you can see, that as the inflation expectations panicked up to 6%, and the inflation did go to 9% coming back, that bond market really said, look guys, what the Federal Reserve is doing on interest rates is just going to send the economy crashing. Interest rates will come down. So you can see that inflation rate has admirably quite behaved at around that 2.5%. And I'm certainly not one to believe in it. Yourself, Sam?
Yeah, so I think, basically you've hit the nail on the head, but we have seen inflation rocket higher, and as you sort of alluded to earlier, arguably driven by, all this money creation, all this credit creation. I also think a large proportion of it was sentiment, and you needed to get the ball rolling from a sentiment perspective, and that came with the supply shocks that we saw in 2020, 2021. And now, you have all these central bankers talking about stopping inflation getting entrenched. And for me, what they're referring to is people psychologically accepting inflation and people psychologically accepting those price increases.
And we were talking about that in the office. The consensus seems to be that companies are prepared now to put their prices up without being fearful of their competitors, because everybody's putting their prices up. So one of the biggest software providers in our industry is Iris. We got their letter the other day. They're putting prices up 9.75% on the 1st of April. But have their costs gone up? Well, probably not. Personally, I've got my Vodafone bill, and they've decided, even though I was on a plan, that the price has been put up 10%. As of the 1st of March, from 50 to 55. As a business, we pay merchant fees on our credit cards, and got a nice letter from the ANZ Bank, and they put my merchant fees up 16%. So I think that if businesses can put up their rates without any consumer backlash, because we're expecting it, as I think you were just alluding to.
Yep.
They're going to do it.
Absolutely. And to go a step further than that, some of the justification being spoken about here is, while their costs have gone up, employment costs have gone up. They can point back to our friend Governor Lowe and say, he's warning about the wage price spiral and the wage costs and stuff going up, that we have to raise prices. And then you go and have a look at the recent Australian wage growth data, and you see that relative to price growth, wages are falling at their fastest ever rate. It's the worst wage growth Australia has literally ever had on record. So I don't accept the explanation that it is our cost of employment. Instead, I think it is that they've seen their opportunity, and these large businesses, they're pragmatic. They are opportunistic.
If you can, you do.
Never let a crisis go to waste, I should say. And, if you're a business that perhaps people need to use your services, or perhaps they're subscribed to them, and, you can just lift your prices.
And that's what's wrong in Australia. Government policy have sold off our private assets. So your toll roads are going up 5-7% a year. Your Port of Melbourne Authority sold off to the big super funds. They put up their rates. Try parking your car at the airport. Try flying with Qantas. Everybody's taking an opportunity, and Australia is a monopoly, oligopoly market where Woolworth and Coles control the growth 80% of the grocery market. So we've sold off our private assets. We've let these companies horizontally integrate across other competitors, and the consumer is basically a sitting duck for price rises. The point is that inflation, the unemployment rate is under 4%, 3.5%. So it is relative full employment. We've got a government immigration policy that wants to put 1 million people into the country, and do you notice rents are going up? So there's obviously we're not building enough houses, because how many home builders have gone to the wall? Mm-hmm. Plenty of quotes of I think there's more home builders have gone to wall so far this year than there was this time last year.
And just to interject there, we had building approvals data yesterday, I believe. Negative 28% in January, shockingly bad number.
And I always like how you point out, look, the gross domestic product might be going up, but it's shared a lot amongst so much more people. So if you look at gross domestic product per capita, it's a much uglier picture.
Absolutely.
And of course, all the extra people coming into our economy puts that downward pressure back onto the wage structure. So, I think our unfortunate thing we might be going for is stagflation, where there is an inflation, inbuilt inflation in the economy for a time, and the average person is going back in terms of real income and real wealth, especially given the what's happened, the decreases in home prices, which happens to be most people's piggy bank over time.
Absolutely. So there's a strong, wealth effect of, house prices relative to, consumer spending and things like that. And, it was a great asset of the Australian economy throughout the last sort of 2 decades. All that house price growth fed back into spending at Harvey Norman and new cars and things like that. Well, what happens on the flip side? And I think we're going to start to find out this year.
So that's right. I mean, the people who bought their homes 30 years ago, house prices has gone up by a factor of 8 to 10. And the biggest money earner in the family happened to be the family home, the best tax advantage, no capital gains tax. If you own an investment property, full deductibility of expenses. If you've got enough money, you put it into superannuation. We're now complaining about the people who've got over 3 million. So people have done what the government told them to do. Now the government's saying, well, whoops, I think we spent a bit too much money. But with all that, I think I'm getting a feeling that there is some inflation entrenched into the system, and we're talking about, okay, inflation's coming from 8% and maybe gets down from 8 to 6 to 5. But it's still 5.
Yeah.
it's like coming back to 2.5.
No, that's the sense that I'm getting as well. It'll come back, but not to those, I think BlackRock called it great moderation levels, those 2 decades of, 1.5%, 2% inflation, unchanged. It might come back down, but it's probably going to find a higher overall level.
That's right. And maybe the other thing too is we're not really recognising the long-term cycle. Is that since 1995, asset prices have been on a tear since Paul Keating gave us a recession we had to have in the early 90s. We've been on a tear for 30 years, and anybody in the industry now, except for us old blokes, wouldn't have a memory of a downturn in the market, and they religiously believe that the house prices double every 10 years. But the problem is that if you're the biggest income earner of the home, is your house, and house prices don't come up, tell me where the holidays are going to come from, the renovations, private school fees.
Well, you're right. The effective household income is halved or whatever it is. So yeah, you're 100% right. And yeah, that wealth effect. On the flip side of things, if the wealth effect from rising house prices isn't there, are we going to see a massive negative wealth effect with the falling house prices? And I'm
trying to moving along. So our view at the moment is I think that governments, for 30 years have been happy that with the cost structure's falling because of China's participation in the market, cheap labour. We've exported all our manufacturing overseas, as the US have, and then we've borrowed all those trinkets we need to fulfill our lives. So we've got a lot of debt on our books and not much manufacturing, and hopefully we can dig a bit more dirt out of holes to pay for our bills. So what's kept us going for that long is a government that's prepared to print money, especially the US government in terms of deficits. I think Obama got the deficit down to 600, 800 billion. I think the latest budget deficit the US is putting forward is 1,600 billion or 1.6 trillion. So the government is going to continue to spend money. And
that's per year.
Sorry, apologies, did I say per week? That was a Freudian slip. No. So the government's going to continue to spend money, and the ramifications of that is, will that be enough to put some stimulus in the economy? Because our economy survives on credit growth, and that's probably one of the reasons we talk.
Absolutely.
So, credit growth is probably a real important aspect.
I do. So we'll move on to that in a minute, but I think this is a good point to talk about. Well, what do you do with all this information? You've just given us a whole bunch of data points and a whole bunch of doom and gloom. Should I hold my shares? Should I look for something else? Should I buy a house? And so I think our friends Macro Alf at the Macro Compass put this chart together. And do you want to just talk to it?
Yeah, I'll talk to that. Basically, this chart, Macro Alf have put together what the global credit growth is. So you call it the credit impulse. So there's a fairly tight correlation between the creation of credit. So credit's created by government spending and bank lending. That's how credit's created, and the other side of credit creation is money that you see in your bank accounts, and we're going to talk about that in a second. So, what you need to do is look on a global level, like the chart in front of you, and say, well, what is the growth of credit in the G5? And he's quite dramatically pointing out in that orange line that the credit growth is retracting. It is coming right back. Our Reserve Bank, APRA, releases bank lending numbers at the end of the last day of each month, and our credit growth numbers also hit the low points where it's come from 5 or 6% per annum credit growth. It's down to the 1 or 2% credit growth. So we are seeing credit pullbacks coming. And what this chart's trying to do is draw the correlation between the blue line is a share price index performance against a treasury bond fixed interest benchmark. And basically the blue line going down is saying the share market is underperforming the bond market. And I think that in terms of the actionable items that Sammy's just mentioned is when interest rates, I remember the 10-year bond rate was close to 1%, and you couldn't make a living on that. If you had $1 million in your superannuation, you were only going to get 10,000, and you're going to have to get taxed on that, weren't you? So it wasn't a great return. So people went into the asset market looking for returns, but pretty much what the thesis is that, look, if you've got a choice between the share market, the bond market, and the cash market, the attractive thing that's happening today that hasn't been here for years is that the cash rate in Australia you can get around 4%.
Yep.
If you shop around, depending on what institution. And this morning in the US, they were advertising cash rates for 5.1%. So if you're nervous, and there's some reason you could be nervous, well, paying 5% on a cash account is not the end of the world. Now, you're not getting much better interest rates as you go out longer in the bond market, the government bond market, for 10 years, because that's around 4%. But there's plenty of opportunities in the corporate market. Sammy and I do quite a bit of
hybrids as well.
Yeah, we do quite a bit of institutional dealing on the hybrids, and there's a massive market where the yields at the moment are somewhere between 6.5% and low 7%, gotten from fairly good bank names and IAG, AMP, that sort of thing. So you have a choice of, look, if you're nervous, do you want to stay in the share market? If the performance of higher interest rates, what effect will that have on companies? Is it time to sort of lift your weight in fixed interest cash and just decrease your weights on the share market? That's something to look at.
And I think, that's what Macro Alpha is sort of suggesting here, that, the return of shares versus like fixed interest or, treasuries in this case, is starting to look a bit negative. It might be a time to do a bit of a switch. And, just if you could perhaps talk to the real world sort of scenario behind this graph, is perhaps that, with these interest rates rising, it's going to lead to an economic crash, and eventually that might lead to, like a bond rally while the stock market falls or something like that.
Correct. How our world is constructed, and I think we started saying it before, is that we say, well, how's money created? We'll just talk about that in a second. How is money created? Well, when the bank lends money, it creates money. When the government spends money to pay for social services, it creates money. But on the other side of money is always a borrower. So maybe we'll go to the next slide. So our title there is How to Create $1 Million. And so we'll show you how the system does that. And any comments later would be much appreciated. So the assets you can hold is cash in your hand. That's your asset, but whose liability is it? Well, it's the government's liability. And you go, well, if they issue cash, that's cash in the system. The only way you can ever kill that cash or pay that cash off is to give it back to the government, to pay a tax bill or something like that. But other than doing that, that cash is out there for forever. It won't go away. I think the Australian system's got about 110 billion in cash. Don't quote me on that. In the circulation, the US system's got about 2 trillion in circulation, ostensibly issued by the Reserve Bank. So that's money, but never forget that's also somebody's liability. And you go, well, how can money devalue? Well, it can devalue if you're Zimbabwe or some despot South African country. Okay, so just keeping moving along the chart and to show how $1 million is created. How any banking system around the world is set up is there's really only one major so-called check account, if you like, a bank account, global bank account, and it's a Reserve Bank account. So the government has an account there. All the Australian deposit institutions, ADIs, which are the main banks and credit unions, they all have Reserve Bank accounts. So that's your main account, and the bank's accounts are like sub-ledgers, of what's in that Reserve Bank account. And in turn, when you think you've got a cash deposit at a bank, it is really if you've got a deposit, the bank's got a liability. You got a deposit for 1,000, bank's got a liability for 1,000, and that 1,000's reflected somewhere in the bank's Reserve Bank account. So money flows between individuals and banks, eventually all wash out in that Reserve Bank account. So just to try and give an example, is that I was just talking a minute ago where Joe's gone to the bank, ANZ Bank, and said, "Look, can you give me a $1 million home loan?" So now this has been tested out, and there's quite a few good YouTube videos on how money's created. And I think the better person is Richard Werner, Werner. If you look up his YouTube videos, he's a brilliant person who really brought how money's created information into the market. So what he found is that when you borrow $1 million, the first thing the bank does is put $1 million into your digital dollars into your account, just a journal entry, and it buys an asset, a loan, a mortgage, which is its asset. So the bank's got an asset of your mortgage, and it's got a liability. It owes you $1 million, and it's just a book entry. Nothing happens. It's just, you got to understand, nothing happens. So now Joe hasn't settled the house yet, but that's the first transaction, and his next step is to go and pay for the house. But the point of the monetary system is that $1 million deposit in the ANZ Bank that's in Joe's name for a second is now money supply. It's a monetary deposit. It is money supply. So that is how money's created. And the idea is that sometimes that the reserves have to be set aside on this particular loan at a time is just not quite accurate. Keep moving along. So he has to settle his house. So he's bought his house from Sally for $1 million. So basically, Joe instructs ANZ to give Sally $1 million. So, and then in turn, the house is transferred into Joe's name, and what you have is Joe now has a house worth $1 million, and he has a loan with the ANZ Bank for $1 billion, so he's square, he's fine. Sally just sold her house, so she's now got $1 million deposit at the bank, at the CBA, and ANZ's quite happy because it's got the $1 million asset of Joe's house. It got that. But the liability is that when ANZ had to pay Commonwealth Bank, what happened was ANZ overdrew its reserve bank account. And because the money was put into Sally's CBA account, CBA has got $1 million in its reserve bank account. So guess what's going to happen tonight when they try and balance that off? ANZ's down, Commonwealth Bank's up. ANZ have to borrow at the reserve bank level, or interbank, or through exchange settlement accounts. ANZ have to borrow $1 million to square up their books. So that's just showing the transaction there. ANZ paid $1 million to CBA. They borrowed $1 million from CBA in exchange settlement. They're square. That's fine. Right. So what we tried to demonstrate, rudimentary, is that how does money created in the system? And it's predominantly, the federal government makes social welfare payments, so that's assets for the people and liabilities for the government. The people spend that money into the economy, and those bank deposits with the customers usually end up with the corporates or the superannuation system, and they're the ones who have the demand for bonds and the ability to create credit. So, and obviously the biggest way to create credit is through the banking system. And when we talk about creating money, the $1 million is always owed to the customer, and the bank's security is collateral. So the world system really survives on the value of collateral, and the most important thing the government needs to do is to do whatever it can to maintain the value of the collateral, because if the value of the collateral goes down, the collateral backing the deposits go down. So if you remember back in 2008 when the US Federal Reserve came out with every package to protect the asset values of especially the merchant banks and the Wall Street banks, they had to protect the value of the collateral. And what do you see locally? What's the Australian government doing? It must have rising house prices to keep the bankings healthy and solvent. if house prices fell by 30, 50%, the collateral issues backing the bank's balance sheets, the liabilities are mums and dads, the assets of the bank are collateral. If it goes down by 50%, there's a lot of prices to pay. And so you got the first home buyer grants. A couple of people in the office here have got 25% deposits given to them from Victorian government. There are stamp duty exemptions. The government's bringing in 1 million immigrants, all these housing demands. And so the health of our economy depends on our ability to create credit. And when you create credit, you also, the side effect is creating money. And sometimes that too much money is what we're feeling at the moment, where if you've got too much money in your bank account, you will make discretionary purchasing decisions to buy goods and services. The inflation we're seeing at the moment, I think, especially services inflation is growing. If you're an asset manager and you're accumulating too much assets, the money just keeps coming into the superannuation system. You haven't got a choice. You've got to go buy that BHP. You've got to invest that money. So what we're facing with now is that if interest rates go too high, we've gone from like 0%, we're going to go to maybe 5% now. The total financial debt in Australia is about $3.5 trillion. Put 5% on that, 2% for a credit margin, 7% of $3.5 billion is about $250 billion.
It's a big drag.
It's a big drag, and that $250 billion has to be found. It has to be somebody's income to pay it off an expense, and so the government's just pushing up these interest rates because it needs to break that inflation backbone. And if they blink and the market gets ahead of itself and pushes, it thinks interest rates are going to go down, these asset prices are just
going to through the roof.
The home price will just go through the roof.
And they'll never get inflation under control.
They will never get inflation under control. And I think we now, if our 30-year time frame is, they talk about a fourth turning, they talk about what is happening. Is this another paradigm for the next 30 years? Look, let's think that asset prices could just go sideways for 10 years. What implications does that have for the average person? If it's going sideways, the baby boomer market is rolling out of its assets. Mm-hmm. The young people particularly can't afford it. You're seeing a lot of corporatisation of homes. So it's how do you get onto that home loan ladder? I mean, without $1 million property in the outer suburbs, 10% deposit, interest rates go to 6-7%, $60,000 a year after tax. There's a lot of issues here, and I don't think we can underestimate what will happen if interest rates do get to 6 or 7% with a low wages growth, mm-hmm. and the corporates pushing in inflation. Yeah, absolutely. I think it'll be devastating. Hopefully, and I think you could argue another criticism of our friend Governor Lowe is that they really had to try and nip it in the bud, and maybe if they ease off too soon, the eventuality will be worse than had they sort of tried to go a bit harder, a bit quicker. And I think the commentariat are really saying, look, the government is doing damage, or the reserve banks are doing damage with these higher interest rates, and they are expecting a recession. Yeah. That would be clear. That if you don't take the foot off the pedal, there's going to be a recession. Now they're going to say lower interest rates. We don't care if inflation's still 5.5%, because we can't afford 5.5%. Yep. If house prices have gone up by a factor of 8 in 30 years, and we've gone back to the interest rates, and I remember in 1995, interest rates did get down to 6, 7, 8%. Yep. So I think we got some real structural problems. We do. And I think, the RBA line has always been, bread and milk is getting too expensive, so pay more for your house. I think now people are,
it may get to the point where people are like, we'd rather pay more for bread and milk rather than pay more for we can't pay any more for our house.
Oh, that's right. So I think we're going to see social change.
Yeah.
Look, and again, as somebody who's been around a while, I'm seeing society attitudes change where, you know, it's not the end of the world where you don't own a home. It's very aspirational. The problem in Australia, of course, we've got no long-term rental accommodation.
No.
You can't do a 10-year lease or a 5-year lease.
No. And we don't really have a long-term housing strategy either. It seems to change every...
I think every time I go over the Westgate Bridge and the government's doing some some tunnel. That's never going to go away. So look, I think it's the market. I'm seeing the market feeling a bit cautious. If you get some good news on inflation, this market's going to go on a tear. I think this is a market of high volatility.
Yep.
There have been some talk, a lot of talk about there's a lot of explosion of interest in one-day options in the US markets. We do a little bit of trading on that for clients ourselves. So, and what we're seeing is there's massive interest in 1-2 day options. So people, instead of hedging their books with 6-12 months options, they'd rather do 200 bets, daily bets for 1 year to get the big one.
Yep.
The problem, of course, for 1 year options is too expensive. And so there's this massive explosion in short-term options.
Yeah, especially when it all comes down to an event, Fed meeting, CPI reading.
Correct.
And this market is the macro market. It is the inflation interest rate dichotomy market. And so a lot of the movement happens on that one day.
Yeah, and as option traders, we know what gamma risk is that you might think the 1 day volatility annualized is 20%, but then when it makes a 50-point move in 30 seconds, you really can't hedge yourself against that. So look, I think we are looking for definitely more volatile times, and I think we're going to see some good news. And when we saw the good news, we saw our 10-year bond rates go from 4.4 to 3.5. Now we're seeing some bad news, and the 10-year bonds have gone back, got over 4% last night again. Yep. So we're going to see the volatility. I think we're seeing a lot of nervousness. For me, the difference this time is, the 2008, 2009 correction, the government came out and said, listen, we're going to support the markets. 2020 COVID, the government said we're coming out to support the markets. And this time, they're not supporting markets.
They can't. And, not until it gets a whole lot worse in the real economy.
And if they come in and support the market, or they bring asset prices back and inflation's not under control, they've got the problem they had in the 70s and 80s.
Yep.
So I think, interesting times ahead. So I think the market is definitely looking at, we've seen some clients switch from a pure equity to pure fixed interest. Been seeing some caution out there in asset allocation.
Yep.
I think interest rates, depending on your risk profile, from 4% to 7%, is some worthy of some consideration. And I think probably paying down debt is probably number one priority.
Absolutely.
For most people.
I think, pretty decent general advice there.
General advice.
As always, only general advice. But, if you do want to chat about anything, we are financial advisors. We do a lot of looking into, macroeconomics, individual investments, research, trading, and always happy to have a chat. So, if you've made it this far, you better be leaving a like. You better be subscribing because, you've just enjoyed a whole bunch of content. And, leave us a comment down below and get in touch.
And thanks for watching us, and have a good night.
See you in the next one. Bye.